Ladies and gentlemen, we have a lot to cover in this video. First and foremost, there's this clip from Tom Lee. He says we could have a positive case scenario from tariffs. I think his take on this is interesting. He also acknowledges the possibility of a recession coming this year. I also want to share this clip with you that says people familiar with history know how dangerous tariffs are. I'm cautious here. This comes from Citibank. And I think it's imperative that you watch this. And also, besides that, we are going to take a look at the week ahead and what is in store for markets from the economic data, but also how markets may kind of gear up for the April 2nd tariff announcement. Whether or not the damage is already done to the economy, we can see this in the soft data, and if this is likely going to translate into the hard data, meaning, is this time to go all in again on this market, or is it time to play both sides, or maybe get out of markets? I will share my thoughts with you in this video. But first, let's start with what Tom Lee says about tariffs and how it could be a positive while also acknowledging some of the recession risks out there.
Let's bring in FundStrat's managing partner and head of research, Tom Lee, a CNBC contributor. It's good to have you. What do you make of this report? I mean, part of the uncertainty of all of this has been the, iron fist, maybe olive branch. Back to the iron fist, maybe an olive branch. What do you make of it?
Well, I think markets should interpret it positively, because I think when we talk to our clients, many are viewing tariffs as punitive, potentially protectionist, and driving several economies into recession. This sounds like that we could actually have a positive case scenario with these tariffs, one that's either mutually agreed upon or if it's reciprocal, but maybe a good deal for businesses. And I think it would set the stage for a much bigger recovery rally than we expect.
Afterwards, right?
Yes,
I mean,
after.
The problem is the paralysis, if you will, between now and then. Like, what are we supposed to do over the next 10 days?
That's the dilemma, right? Because we still have 8 trading days till April 2nd. Most investors are getting just nauseous from the volatility, so they want to throw in the towel. But we also know that markets will bottom, or have historically bottomed, before the event actually happens. The best example is the Cuban Missile Crisis, 1962. That was a 12-day crisis. The stock market bottomed 7 days into that crisis, recovered 2/3 of the losses before the resolution. So I think that's a decent template for today.
What about the economy? I mean, listen to Nike, FedEx, put that on top of what we've already heard. Are you concerned about where the economy's going?
It's been pretty shocking how quickly sentiment deteriorated. I can understand for consumers because the president's very divisive, but for CEOs, that's been a shock. CEO confidence has fallen, and they've kind of been sitting on their hands. So we know there's an impulse of a growth shock underway. But if this is something that doesn't last months, then it's very temporary.
I mean, it depends, to what degree consumers remain skittish. CEOs are paralyzed in their own right because they can't really make any moves because they're not sure what's going to happen, and ultimately whether a growth scare spirals into something else, which Jeffrey Gundlach gave me his view yesterday right here on Closing Bell. Listen.
I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
50, 60%? I mean, if he's right, what does that mean for the stock market? Way too expensive.
Well, the S&P had a 10% drawdown. That's already priced 40% chance of a recession. I'd say the markets aren't agreeing necessarily with his view because China, Europe, Canada, Mexico have been massively outperforming the U.S. since February 18th. Those economies should be tumbling into recession if we have punitive tariffs. So I think markets are actually more paralyzed than necessarily pessimistic. And
I'm sorry, finish your thought.
But because the market is the economy, I think to the extent that stocks rebound sharply after April 2, if they do, I think it really staves off future economic
Is the
weakness.
market the real economy?
I think it's these days, to me, I think it's a really good snapshot of actual sentiment and actually even CEO decisions. Because as you know, when stocks fall, companies lose confidence. And as stocks recover, CEOs gain confidence.
about the idea that Gunlock also put forth that in his words, unintended consequences of all of the rhetoric from the president is making people think twice, especially overseas, about investing in the U.S., and the view that Europe is just a better value and offers even less risk than before. How do you play that?
We hear a lot of folks talking about that, but as you know, Europe tends to be single stock concentrated indices. So if you're buying Europe, you're basically buying industrials and financials. If you're buying Korea, you're buying Samsung. So I think if someone is looking for the best companies, they're still going to end up buying the U.S. One of the things that we have to keep in mind is this trade deal, if it's acceptable, could actually basically sort of blunt this whole issue of trade in the future, and it would actually make the U.S. more attractive again.
Now, I actually thought it was funny that CNBC used that title. They really took a bullish spin on that. And Tom Lee was kind of bullish, overall, I would say. But one thing I found interesting is he said the stock market is a pretty accurate real-time assessment of the economy, of business decisions by CEOs. That's interesting because sentiment has deteriorated alongside this market. And what everyone's really trying to figure out, to bottom line this, is the soft data going to translate into the hard data? And Grok is going to kind of give you some context for this. It says, I asked the question, does soft economic data usually flow through into hard data? It says, yes, soft economic data usually flows through into hard data, but the relationship is not always direct or guaranteed. You're looking at surveys, PMIs, some of the soft data. It's capturing expectations and perceptions about the economy. And it usually does flow through into the hard data, but can work with a lag. It says historically, soft data like PMIs and consumer confidence indices have been used as leading indicators for hard data. Economists and analysts rely on these metrics to predict future economic outcomes, suggesting a meaningful connections. But the flow through from soft data to hard data isn't always consistent. Now, where we're at right now is fascinating because we have weak soft data. Hard data is okay. We've seen some weak hard data like retail sales, consumer spending, okay, in just the last month. Okay, 1 month doesn't make a trend, but all trends start with 1 month. You've heard that before. What I actually think is the most telling is corporate America and earnings season, okay? Walmart, Target, Best Buy, Delta, name the company. They've warned about the consumer in one way, shape, or form. Even Ollie's warned the bargain retailer that people are, shopping for things that they need more so versus discretionary. FedEx, Nike, they're all saying the consumer is slowing down. Even Dollar General said even in the last couple of weeks, the slowdown has been accelerating. And it seems like it started in January and went throughout Q3. That is what JP Morgan said on CNBC as well. So when I look at all of these things and I think about what's different now versus maybe like 2022, we now have a shock to the economy. Okay. The shock to the economy is Doge, consumer confidence, and a business shock. Okay. Business leaders, CEOs, nobody wants to make capital allocation decisions or CapEx decisions right now. Austin Goolsbee said that on CNBC yesterday, that there has been a sharp uptick of anxiety, of hesitation. And that could ultimately flow through into the labor market. What will happen first, and what I think we're seeing now, is people cutting back spending. Okay, I think probably Doge and some of the, high profile firings are causing people to get nervous. 10 to 13 million people rely on the government, whether it's the 3 million that work at the government or people that work in companies that are mostly contracted by the government. There's about 8% of the workforce that ultimately relies on the government for employment. Within that, those people are likely severely cutting back on their spending. Now, I will also make the argument that I think a lot of you would agree with, that lower middle income consumers have felt like we've been in a recession for a long time. Their spending is already slowed. But it's the higher income consumers. The higher income consumers, the top 10% of income earners in the economy, account for 50% of all dollars spent in the economy. That is a crazy number. Now, what I view this shock, right? This shock to the economy is not really middle or lower income consumers, unless you watch the news and you know what's going on with Doge and all that. It's the higher income consumers that are feeling the shock here, whether it's stocks that have fallen quite a bit and the volatility there, whether it's home prices that are stalling out, that are starting to fall in most major markets, or here's the big one, this top 10% income earner bracket, they're the ones that own the businesses. They're the ones that are feeling the nervousness right now around tariffs and around government policies. That's where you're probably seeing the slowdown, more of the slowdown at this point of consumer spending. Considering that top 10% of income earners account for 50% of consumer spending, it could be hard to avoid a recession here. Now, the question is it a deep recession? Does it last a long time? And those are obviously questions that I do not have the answer for. The economy these days, pretty resilient. And honestly, you probably need a recession to clear things out. And, hopefully we don't see this, but I know some people would like to see this. You think you'd like to see this, but you really don't. That is a little bit of disinflation or deflation. Deflation is really bad, really, really bad. It creates a feedback loop, which leads to more layoffs, more deflation, more layoffs, more deflation. You do not want to see deflation, in other words. But if we could get an environment where maybe prices some disinflation, right? Like inflation starts to really undershoot even the Fed's 2% target. I know that feels a long way off, but if we go into a recession, you're not going to have an inflation problem, okay? Maybe lower middle income consumers can start to recover a little bit, obviously, if they don't lose their jobs. Maybe that could actually be what we need at this point, because since 2022, middle and lower income consumers have reported they've been in a recession. They've felt like they were in a recession for a long time. If we could start to get the middle of the economy or consumer working again and feeling better again, that's going to lead to more prosperity over the medium term, if you will. So I think that's the big question right now. Is the soft data going to translate into the hard data? Historically, it would say yes. Now, I think in terms of markets, we're kind of over the whole tariff uncertainty thing. I think Wall Street, again, already kind of knows the deal with tariffs. I don't think we're going to be surprised. Reciprocal tariffs, okay? If you tariff us, we tariff you. I don't think there's a big surprise there. I think what we're really trying to figure out right now in markets is what is coming next for the economy. Are we heading into a recession? Okay. Are we not? That's the big thing. And you've discounted some recession risk, but the issue is if we did go into a recession, the average recession EPS is going to fall about 15% from 2024. Times that by a 17x multiple, you're looking at about 201. For S&P EPS times 17, you're looking at about 3,417 on the S&P 500. On the SPX, that's about 341. That's almost your lows of 2022. Now, you could be a little less, extreme. You could say 210 times maybe a 19 multiple. You're looking at 3,990 on the S&P, or about 3,999 on the S&P. I mean, 399 on the S&P is still 29.5% downside from here. I see it, or I view it as, if things go back to normal, just we had this shock in the economy, it didn't lead to a recession, business as usual transpires, at best you're going back to about 610 on the S&P. I mean, that's like 8% upside from here. So no matter which way you want to look at things, I don't see a good risk reward out there in the markets. And that's why I'm a little nervous here. That's why I'm keeping as much dry powder on the sidelines as possible. Unfortunately, I think we've really just lacked a catalyst to push us into a recession. Recessions start with confidence issues. That's what you're seeing right now. A confidence crisis with companies and executives, higher income earners. I don't think tariffs really move the needle on how average citizens spend money, right? I don't think people look at the news and say, oh, tariffs are coming. Yeah, I don't want to buy right now. People don't do that. They buy what they need. We've been in that situation for a long time. People have been mainly just buying things that they need, right? The discretionary spending wave is long past. But with companies, you're getting this confidence crisis. Is that enough to push us into a recession? It could be. And I agree with Jeffrey Gundlach. 50% chance of a recession is possible. And in that scenario, stocks could fall a lot more. What I kind of disagree with Jeff Gundlach is I think treasury yields would come plummeting down, because in an inflationary environment, you're not going to have inflation, right? Inflation is going to be below 2%. Because why? Because if people stop spending as much, which I think has already largely happened but could get worse, factories still need to run. If factories do not sell all of what they produce, they start to lose a lot of money. Okay? So at a price, price is important. If you're, no matter what it is, this, call it Raisin Bran, my favorite cereal, okay? This Raisin Bran, at $5 a box, I might buy it. I might not. If I start to get a little nervous about the economy, I might not buy a $5 box of cereal at the small box at that. You give me this thing at $3? Oh, I'll buy it all day. Okay? So that's what tends to happen during recessions. Price speaks. It could be Raisin Bran. It could be this Axe body spray. At the right price, people are going to buy things. And that's where you start to see some disinflation, even deflation in some products. Now, too much deflation is obviously not a good thing, but that's why you don't have inflation during recessions. Because companies will undercut other companies. They will lower prices to sell products to keep factories pumping at max capacity. Okay, the only worst thing than not selling your product is slowing down production at the factory. That's typically really bad for margins. Okay, you'd rather cut prices on products than slow down your factory. And I think that could be maybe the next stage we start to get into. Now, tariffs. I think whether or not they stay on, get delayed, or go off again, you've already kind of started the problem. Okay? The problem is the confidence. Are you really going to make a decision right now with an environment that is changing day by day? Like a big business decision? Probably not. Okay? For an example, if you are, let's say, Apple, right? And you want to continue to sell your iPhones, right? That's what Apple wants to do. and you think you're going to have a 20% tariff on China forever. Okay, great. Now you're committing to build factories in the US, and you're going to have to pay people more. It's going to be more expensive to run your factories in the US, but it's better than paying a 25% tariff in China. Well, what happens if the tariffs get delayed? Then all of a sudden, maybe you don't need to build that factory in the US. Maybe allocating that capital to building a factory in the US is the wrong decision. Okay, so no matter what really happens in the short to medium term, I think the damage is done from a confidence perspective. And now I really think it's more of a wait and see kind of approach to what happens in the economy. I think Fed Jerome Powell kind of spilled the beans as well this last week. They are concerned about the economy. And as things get worse, they will be cutting rates. And I think the Fed thinks things will get worse. Now, they obviously can't signal that because that would cause some, problems in the markets, which would amplify the effects in the economy, right? Because of that wealth effect, okay? But I think if you had Powell in a closed room with no mic on, he would tell you, yeah, I think things are going to get worse, okay? That is, even though the Fed is your friend, the Fed put, if you will, is back, that's not a great backdrop for stocks. Especially when markets are this expensive. Take a listen to this clip that says people familiar with history know how dangerous tariffs are. I'm cautious here.
To the market action with Citi Research Director Drew Pettit and Ariel Investments Vice Chairman Charlie Babrinskoy. It's great to have you both on here today. And Drew, I'll start with you because I'm looking at your notes and you seem pretty constructive on stocks here given the drawdown we've seen in recent weeks.
Yeah, look, I think the message we're trying to send is stay the course. When we were talking about the first half of this year in December, it was about first half volatility. And then all of a sudden, when you get it in policy uncertainty, which a lot of people were talking about, then do you really need to freak out or not? Look, we understand there's still some uncertainty ahead around tariffs and the impact on earnings. But at these levels, let's call it 5,600 today, feel a lot better than we did when we were trading, north of 6,000.
Charlie, do you feel a lot better, especially as Mike Santoli put it just a few moments ago, we're in the midst of peak policy uncertainty?
Yeah, this may surprise you, Morgan. I get accused of being a perma bull. I've been pretty bullish on the economy for 4, 5, 6 years, and I'm cautious here. I think people are familiar with history, know how dangerous tariffs are. It is not an exaggeration to say that the Great Depression was caused by Smoot-Hawley and a trade war. Tariffs, the fundamental document in capitalism is The Wealth of Nations by Adam Smith, written in 1776, which made the argument for free trade. It is a foundation of our economy, the world's economy, and we are playing with fire. I think this is very still dangerous. I hope people are right who think that Trump is bluffing, but if he's not, and he's really going to put these tariffs on, it's going to be very painful and more painful than what's reflected in the market right now.
So, Drew, is this mainly a question of whether or not you think a recession is likely here?
I think it's how deep and how long. We've said this looking at the data over history, is if you really want to know where the S&P was going in the 80s, figure out where GDP is going. If you want to figure out where it's going today, it's a little bit more about secular trends, not to completely divorce the two from one another. But look, I just think, recession is going to hurt the growth side of the market, but there's still some secular tailwinds. There's still a lot of focus on productivity. And I think there's a lot of levers companies are going to pull, and they're not just going to take tariffs and changes, just kind of lying down, sitting back. So to us, look, I'm probably more glass half full than Charlie is here. But at the end of the day, tariffs are a negative. We really do need to get past that if we want serious upside.
Charlie, on top of that, student loan defaults are starting to hit consumer credit scores. What's the impact, you think, of that going to be, and how should investors position if they're concerned about it?
I think you got to broaden that. I think it's not just student loans. I think it is the consumer got big payments from Washington in the COVID years, and they have gotten big payments that are now slowing down. And I think Brian Moynihan said something that surprised me. He said the consumer is in better shape than people think. I don't see that. In the portfolio companies that we talk to, we think the consumer is okay. There's obviously very low unemployment, but the consumer is feeling some strain here. And so you're going to see it with some higher student loan defaults. We're going to see it with credit card payments being a little weaker. I think the consumer is not in great shape.
Let's be honest, the consumer hasn't been in a good place for a while. We just haven't, again, had that shock to the economy to push us into a recession. And you can make the argument that we do have that shock now. Is that enough, though, to push us into a recession? Time will tell. If you look at the soft data, clearly it could be. Does that translate into the hard data is the real question. Now, from a tactical perspective on markets, if you're a bull, you want to get above that 200-day moving average. You've been finding a lot of resistance there. What I see as a little unnerving, if you will, is like the RSI and the SPY is back up to 42. You're no longer even close to oversold. So markets can come down here without the RSI hitting a new low, kind of what you had in 2022. So I think the next week, 2 weeks, is especially around tariffs, is going to be absolutely critical. Do we find a stronger footing here? Do we get back above that 200-day moving average, or do we fall and set a new low? You can see this with the VIX as well. The VIX, hit almost 30, came back down to 19.28. You've reset your fear, right? So now the VIX could even move higher again without hitting a new high, and markets could hit a new low. So from that perspective, I think you want to be a little cautious here. I think having as much cash on the sidelines as possible is the best move no matter what. Okay, because even if we avoid a recession, I think there's going to be some deals out there that do come along. And honestly, I don't think the worst of the economic pain is behind us. I mean, Bessent, Trump, they've all said, like, essentially, we could have a recession. Seems like Wall Street's not really paying attention to that. They're hearing what they want to hear and dismissing what they don't. So, just my thoughts. Let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.